Thank you for joining myself, Flo Williams, Tonette Campbell, and Annette Bill this morning for our Mortgage Madness workshop. Before we get started, introduce our special guest speaker. Wanted to go over a few housekeeping rules. So when you come in, please make sure that you are on mute. If you have any questions, we're going to leave those at the end. So if you have questions during the presentation, just go ahead and put them in the chat and we'll make sure that we address them at the end. You are not required to be on camera. So if you have a lot of things going on in the background, we just ask that you turn it off so that way we can focus on the actual presentation at hand. So without further ado, I'm going to turn it over to Pamela, it looks like we lost Tonette. Turn it over to you, Pamela. Let me know if you are able to share your screen.
Okay, yep, I'll go ahead and do that now. Are you able to see my screen?
Yep, we can see it.
My company, as I mentioned, we are a local direct lender. So we actually don't do any other type of banking other than mortgages. So we, are going to have access to every program, product, grant, down payment assistance program, typically that is out there in the marketplace because we strictly focus on mortgages. Being that we are local, we're going to know all of those programs, all the specifics of what it takes to obtain financing here in the state of Maryland. And when you go to place offers, that definitely matters. It's a very competitive market. Listing agents or sellers agents for properties you may place offers on want to know and be able to speak to your lender and be familiar with them. So our reputation really truly matters, and the fact that we are local and that the listing agents can reach out to us and speak to us and may already know us and be familiar with our company definitely does matter in such a competitive market that we're currently in. So just to kind of give you a comparison and kind of pointers of why buying real estate is so beneficial and important. So basically the main benefits of owning a home is one of the biggest key factors is that the mortgage interest is tax deductible. So a lot of times I'll have buyers say to me, okay, well, I'm paying $1,500 a month in rent now. I'd like my mortgage to stay the same. Well, renting versus owning is not an apples to apples comparison because 95% of your mortgage payment, you're actually going to be able to write off on your taxes. Therefore, getting a larger tax refund, be it at the end of the year, or I have some clients who even raise their deductions on their pay stub, so they're getting more money back in their paycheck because of that tax savings. So typically speaking, say a mortgage payment of $1,800, you're probably saving about $300 a month in taxes with that additional write-off that you'll have. So that's where when you're budgeting for a home, it's going to be different than what it is like to pay rent. Also, obviously, you're going to be building wealth with equity. So I've had clients who even in the last, say, 3 years, have gained a tremendous amount of equity with the natural appreciation of homes and real estate. So as your home value is going up, you're also going to be paying down the mortgage. So again, that's where renting versus owning is so completely different. Obviously, when you're paying rent, you're not gaining anything, nor are you having that write-off. Obviously, also, you're going to be have the pride of owning a home. The freedom to also modify the property. So if you want to paint the walls lime green, you have the free will to be able to do so. If you want to add an addition, you want to add an in-law suite, owning a home, you get to truly make it customizable for yourself. And obviously with renting, you typically cannot do that. And then also owning a home, when you're putting money into the property, you're increasing the value. So whether you renovate the kitchens, bathrooms, any of the money that you put into the property typically is going to increase the value of it. And then of course, lower cost of living. As we all know, rent continues to go up. I'm a landlord myself, And right in all of my leases, it states that the rent within the following year is going to increase and that we're going to need to rewrite their lease. With a home, that's not going to typically happen. If anything, most likely your mortgage down the road will go down with the removal of mortgage insurance. So it's the one way to put a cap on your housing expense that we're all going to face. Many times the obstacle holding potential buyers back is the lack of down payment. However, we have access to tons of different programs that can assist you with that. I actually partner with the state of Maryland's down payment assistance program. So we're one of their preferred lenders, and we can access funding through their programs throughout the entire state. All right, so the next slide just kind of gives you an overview of the steps of the pre-approval process. So the first step would be to speak with a loan officer and review your information regarding your employment, your income, your savings, your credit. That conversation usually takes about 10 minutes. At that point, that's when we would determine, what you're looking to spend and also what I can qualify you for. A lot of times on that first call or that first kind of getting pre-qualified, sometimes we may not be able to qualify you right away, but I always think of everyone as that there's never anyone that's denied. It's really just some people need the steps in place to get them to be approved. So whether that takes maybe, another month or 2 or 6 months or whatever the case may be, at that initial call, we would be able to put that plan in place to get you to the point of being a buyer. So everyone can buy. It's just sometimes takes different steps to getting there. If we are able to approve you, we would go over what your maximum approval amount is. And then we would also go over numbers that fit into your personal budget. Most times I can approve clients for more than what they're wanting to spend. So I can give them that ceiling and then back into what their personal budget is. At that time, when we approve you, we're also going to chat about any assistance programs that we can qualify you for. So those assistance programs will depend on who your employer is, your credit score, which county you're looking to buy. So at that time, we're going to give you all the information on any additional funding that we can access for you. Also at that call, we would then request a set of income documentation that we would need to verify prior to you placing an offer. That step is really important because when the seller's agents call us, they're going to want to know that we verified your tax returns, your W-2s, your pay stubs. So doing a thorough approval is really doing our due diligence to make sure that there's no hiccups down the road once you go under contract. Once we've reviewed those income documents, you're then given the green light to go shopping for a home and placing an offer if you did find a home that you wish to do so. Your real estate agent will be the one who helps you negotiate and write the offer. I think of your real estate agent sort of as like a project manager of the whole buying process, almost like an attorney overseeing your financials and your negotiations. The seller's agents are they're going to be representing the seller, and then your buyer's agent will be representing you. And I always think of, like I said, your agent is almost like an attorney. You wouldn't want to go into court where the sellers have their own attorney without you having your own representation. So it's very important, the relationship with your agent, making sure that you have someone very hands-on that's representing you. Even if you're buying new construction, I highly recommend always having an agent because you never know what type of negotiations or things that you're going to run into. So having them on your side is incredibly important. Once you have made your offer and gone under contract, meaning that the seller has accepted the terms and you have a ratified contract, we would then complete your loan application and then get it ready for what we call processing and underwriting. At that time, usually once we're working on processing your file, you may have a home inspection. In the current market conditions, a lot of folks are actually waiving inspections, and that's something that you and your agent would work through to determine if you prefer to have an inspection or not. Once you've gone through the home inspection, your mortgage loan would then go into what's called underwriting. The underwriters verify everything that we've provided for the file. So they would verify your tax returns with the IRS. They would verify your employment with your employer. Basically, they go through the file with a fine-tooth comb and then issue what are called conditions for the processing of your file. Typically, those items are, confirming your funds to closing, verifying maybe an updated pay stub. At that time, we would have also obtained an appraisal for your new home purchase. The purpose of the appraisal is to confirm that the purchase price meets what the appraiser deems the value of your property to be. And that value is typically based on 3 to 4 comparable sales similar to your property that you're purchasing. Now, if the property were to possibly under appraise, at that point, you and your agent would then go back to the negotiating table with the sellers. So the sellers can either agree to the lower price or they can reject it, and you guys can determine if you want to come up with the difference or if you guys want to end the contract at that point. So that's another key area where you'll find that your agent is incredibly important to help you through all of those negotiations. So once we've provided all of the final items that the underwriting department requests, you would go into what's called your final underwriting stage, and then the underwriter would issue what's called the clear to close. At that point, you're ready to celebrate and get me finally out of your hair. So all of our tiny requests that we have to document for your file will have been completed at that point. And then you would meet with the title attorney or notary to sign your closing documents. At closing, that is when your funds for the purchase would be due. So any money for closing at that point, you would either wire or bring in the form of a cashier's check. You would then sign the closing documents and the deed would be transferred to your name. At that point, you can move into the property. In Maryland, we're a wet funding state. So basically you would be able to move in right away. All right. So I touched on the documentation that we would need for your mortgage approval. So here's an overview of typically what we're looking for. So 1 month of pay stubs, 2 years worth of your W-2s, 2 years of tax returns, contact information for your employer. If you're self-employed, we would need 2 years of business and or tax returns. If you're retired, an awards letter for Social Security pensions or annuities. Asset documentation would be, verifying that you have the funds to close. And then we usually are typically getting a copy of your driver's license, and down the road, you'd need insurance information or mortgage statements for any other properties. Now, one thing that you'll find with mortgage banking is that there's actually the part that I love about it is it can be incredibly creative. So as you can see here, it says 2 years worth of W-2s. Not in all circumstances do you actually have had to have worked for 2 years. So let's say, for example, you were in college for the last year, then 2 years of W-2s wouldn't be applicable. And the fact that you were in school is actually, we can use that as work history. Or let's say you were on maternity leave or taking care of your children. So again, not necessarily do you always need these items. Everyone's situation is different. And there are different ways to get loans approved if you don't have all these specific items. So, and that's something that your loan officer would go over with you upon approval. And as I had mentioned, the approval process and having a thorough approval is very important. Typically all weekend long, I'm verifying clients' approvals with sellers agents, confirming that I've gone over all of their income docs for my pre-approved buyer and that we've done a thorough approval for them. Working with someone, a loan officer that is available around the clock is really important. Literally taking calls at 9 o'clock on a Sunday evening so my client's offer can get accepted is an incredibly big part of the process. So if your loan officer isn't hands-on, I highly recommend getting someone who is, because that's going to separate you when you're placing offers. The market is very competitive right now. So typically speaking, my buyers are competing with anywhere from maybe 5 to 10 other offers. So anything that I can do from a lender's perspective to make them more competitive is really important. So again, here's just an overview of the process. You're going to complete your initial approval, then you're going to begin house hunting. You will then make an offer and get your contract accepted, and which is when we will go into processing and underwriting with your file. Once your file is then approved, again, we're going to issue that clear to close for you. A couple of do's and don'ts for the home buying process. So when we are approved and go and under contract, the process moves very quickly. So we ask that all clients send in their documentation within 48 hours of being requested. Continue to pay all of your bills and mortgage and loans on time. So when we approve a client's file, we are approving them that exact way that they are today. So if they were to say pay a credit card late or go and spend their savings that they had, that changes that approval file and that profile, and that can literally knock it down where we then can't approve it. So continuing to pay everything on time. Scheduling your appraisal right away is also important. So as soon as we get the contract, we are literally ordering your appraisal within 2 to 3 business days typically. And then also talking to your loan officer about any questions. So for example, I have a lot of clients who want to buy new appliances, new furniture. Giving us a call and making sure that that increase in spending isn't going to change your profile is really important. For a lot of folks that, they have the green light, they can go and do that. And so for some people, they can't. There is a back-end credit monitoring that all lenders do while your loan is in underwriting. So if you increase a debt or you pay something late, we actually get notified of that, and it can cause us to have to re-pull your credit. So just keeping everything the way that it is while we're working on your loan is really important. So another don'ts that we ask is to not allow anyone to pull your credit, which pulling your credit scores can lower your score. So we ask for you to maintain your credit scores and credit profile the way that it is. We ask people to not move the credit balances because that can change your profile as well. And making any major purchases. So a lot of folks think, oh, I co-signed for a student loan for my daughter. That's not going to change things. Actually, it truly can. And we would have to then also include that in what's called your debt to income ratio. So again, leaving your credit as is. And quitting and changing employment. Now, not necessarily changing employment may not affect your profile, depending on if it's a salary increase or whatnot. But again, talking to your loan officer about any changes to your financials is really important. All right. So credit. So credit is one of the things that I think there's lots of misinformation out there. A lot of credit repair companies I see are not really actually improving clients' credit. So it's something that I am really passionate about because I find that a lot of folks just don't know about credit and how to actually build a healthy credit score. So the number one recommendation that I can give is regarding credit and the way to boost your credit score, and I would write this down, is the usage of a credit card. So student loans, car loans, mortgage loans, any of those types of credit debt are not going to actually pump up your credit score. They're not going to build that muscle. The number one way to do that is through the usage of a credit card. And what I recommend with the credit card is to use it to only 20% of the limit of the card and then paying it off to zero every month. So up to 20% off to zero. So for example, if the limit on the card is $1,000, I recommend only charging up to $200 and paying it off to zero. So a lot of people think, oh, I have a $950 balance on my $1,000 limit credit card and I'm paying it every month on time. I'm probably, fine credit-wise. Well, that actually puts a tremendous strain on someone's credit. Having that balance near the limit, even if you pay it on time, is actually pulling down your credit score. So again, that low balance usage to 20% and paying it off to zero is showing that you can be given money on credit and pay it back in a responsible way. So that's my number one bit of advice on building credit. And then of course, the obvious, pay everything on time. Don't allow anything to go into collection. The number one thing I see pulling scores down, in addition to maxed out credit cards, are small medical bills that get billed incorrectly that we think our insurance providers are going to cover for us, and yet they're not, and we're getting billed for them and somehow not, maybe receiving that bill to cover it. So, a $50 medical bill is then damaging someone's credit. So making sure all your medical providers have your correct address, that you're following up on those bills, and making sure that everything gets paid on time and doesn't go into collections. So that's kind of my overview on credit. So again, here's just an overview of the 5 different steps of the mortgage process. The loan application, processing, underwriting, submitting your financials, and then receiving that clear to close from our underwriting department. Now what I'll do is open it up for questions. Typically, usually after I've given you that, usually there's some good questions out there.
I do have a quick question. I know you had mentioned that, every circumstance is different.
Yeah.
And that if, like you used an example of a student, what about folks who were, where COVID came into play? How would you, I have people in the hospitality industry where their job was cut at a hotel or something like that. How would you address a situation like that?
So it depends on their situation with how long now have they been back to work. So if they've been back to work, say for 6 months, we're fine. So most COVID things, most COVID job layoffs have been farther out than 6 months. So we're not typically seeing that that's affecting people now. Now, when it comes to fluctuating income due to COVID, we are able to use a more recent history to exclude the COVID downturn somewhat. So say, for example, again, most COVID income losses were really in 2020, we're finding. So for 2021, we can use, say, 2021's year to date, 2021's income plus the year to date of 2022, where then we can exclude 2020 and not have it affect us negatively. So typically speaking, COVID isn't causing us hurdles anymore. Knock on wood. Thank God. Thank goodness. So, but there is some exceptions for that where we don't have to include it. Basically, we're able to go, okay, look at 2021. We know in 2020 why it was lower, and that's why we're going to exclude it. Good question.
Thank you so much.
Sure.
I have a question around student loans. Do you work with them? I have a lot of clients that have student loans right now that think that that it's holding them back pretty much from buying a house. And I know there's a program out there, of course, that has requirements. Do you handle those or work with those?
Yeah, so lots of good news surrounding student loans that I'm happy to share. So FHA, conventional, USDA all just improved their guidelines regarding student loans within the last month. So this is like awesome. So now we are able to use what's called an income-based repayment plan. So for example, let's say my client has $20,000 in debt, typically that income-based payment plan may be like $100 a month. Whereas before, we were required to use a 0.5% of the balance payment against their debt ratio. So this is going to improve for a lot of those buyers with student loans that we are able to now qualify them using this income-based payment, which is typically, in line with what their income is. So therefore, it should open up a lot of approvals for us. And then regarding the student loan program, so the Maryland Mortgage Program offers a program called the Smart Buy 2.0. The program is absolutely incredible. It allows you to pay off up to $30,000 in student loan debt with the purchase of a home, or 15%. So 30,000 is the cap, depending, and it's 15% of the purchase price. So $200,000 loan, 15% of that will give you $30,000 to pay off your student loan debt. The kicker with the program is you do have to have a 720 credit score. Now, let's say your credit score is 700 today, I could probably give you tips to get your credit score to a 720. So it has a pretty high credit score requirement. The other quirky part about the program is that you have to pay off all your student loan debt at closing. So let's say you have $50,000 in student loan debt, the state's giving you 30 to pay it off. You would have to have the ability to pay off the other 20. So that's the part where it's a little tricky to fit folks into it. But last year alone, we paid off my branch, which is me, being a loan officer, paid off over $100,000 in client student loan debt. So we are using it a lot, and it is absolutely incredible. It also gives you an additional $5,000 towards the down payment. And the down payment on the program is 5%. So whenever I can see folks that fit into it, I'm ecstatic because it's absolutely incredible. So, yeah.
That's awesome. So just to make sure, that was up to 30,000 towards their student loan, and
Yep.
it also gives 5,000 towards closing.
That's right. Yep.
Okay.
So you can stack it with that 5,000.
Perfect. We also have a question in the chat.
Okay.
What FICO score do you use, and what's the minimum score to qualify?
Got awesome. So we pull all three credit bureaus, which are through TransUnion, Equifax, and Experian, and then we go off of the middle of all three. So for example, if your low score is 700, your middle score is 720, and your high score is 740, we use the 720 to determine your pricing and eligibility for the loan. And our minimum credit score is currently a 580 for VA loans and a 600 for FHA loans. So I think in the marketplace, we are pretty aggressive. I think when it comes to credit scores, also when it comes to income, debt ratios, we are probably as aggressive as I believe the industry allows. So, and even if your score is, say, a 580 or 600, a lot of times we'll talk about credit repair just so that I can improve the interest rate that I'm able to offer you. So even if you qualify, we may talk about ways to bump your score up just so I can give you a lower interest rate, which then therefore equates to a lower mortgage payment.
Okay. Now, one of the questions was, let me just go back here. As far as the type of FICO score, they were asking which model. So is it the FICO 8 or FICO 6, the 4? Do you know which model you all use?
I'm not familiar with what that is.
Okay.
I'm not sure what that is, but there is no model that we use that we use the credit score. There's no model that I've ever heard of.
Okay. And then,
looks like
Tanette, my colleague,
about the Maryland mortgage program.
Yes.
Yes.
Can you talk more about the program and the candidate for it?
Sure. So the Smart Buy so the Maryland mortgage program offers several different programs, and those are, constantly changing. The Smart Buy student loan program is one of them. There is also a program for disabled clients or the caretakers of them. That particular program offers a 25% silent second mortgage. So that one's awesome if you can qualify. Their most popular programs are their flex programs that give between 3 to 4% towards the purchase of the home. So for example, there's one program that gives 3%, and that's considered a down payment assistance program where you pay the funds back when you sell the home. Or at a higher interest rate, there's a 3% program that's a grant. The grant means that the funds are given to you for the purchase. So for example, $200,000 loan, 3%, they would be giving you $6,000 towards your down payment and or closing costs. Then the other option that they offer is a 4% program. So that one in that example would give you $8,000 towards the down payment and or closing costs. So when we approve folks, we go over all of those different options. Each of them have different interest rates, which change daily. So we would go over which one and which interest rate is applicable for that day. And then once you go under contract, you could determine which program you prefer to use. So their programs are very popular. They require a 640 credit score, and they do have income limits. So when we approve clients, we're going to fit you into that bucket based on your household size and your credit score. And they offer those programs with either an FHA, conventional, VA, or USDA loans. So we would pair you up with the particular loan program and the product through the state that they offer that's applicable for you. And then also, just to throw some other down payment assistance and grants, Baltimore City has some added programs depending on the property and your eligibility. There's typically between an added 5,000 to 10,000 that we can get in the city. Howard County has an incredible program that can give you up to $40,000 that I love and is really easy to work within. There's very few lenders that can access that one, and we're one of them. I think there's like 15, and we're one of those 15. Montgomery County has some added funds. PG County sometimes has some added funding. I think right now they're out of funds, but that typically gets replenished in the summertime. So depending on which county you're buying within, there's some things we can also add on and stack for you.
Do you have any flyers or information about the Howard County program?
I do, yeah. Yeah.
Okay, beautiful.
I could email that out if you'd like.
Okay, perfect.
Sure.
I have a question going back to credit. So I've heard that in some cases, if you don't have a credit score, you can still get a mortgage loan, a pre-approval. It's just based off of your credit history, things that you pay. So like your rent, your Verizon bill, car payments, things like that, that could help you get a loan. Is that the case across the board, or is that just with certain lenders?
That is certain lenders. So we can do that as well. I typically avoid that because the interest rate will be higher. So instead of giving the client a higher interest rate, what I would tell them is go get yourself a credit card, charge $50, pay it off to zero next month. Typically speaking, someone with no credit, I can get their credit score built up within 1 to 2 months. So I've had a client who had no credit. Literally 1 month later, they had a 700 credit score by the usage of that credit card. So therefore, I can give them, say, an interest rate in the low 4s versus the low 5s. So we really try to avoid that just because of the higher interest rate that would be applicable, but it is doable. Good question.
I have one more. So as far as, I know you said you do back-end credit monitoring. So as far as your pre-approvals, how long are they usually good for?
So the back-end credit monitoring occurs throughout closing.
Right.
So right up until closing. When we do a pre-approval, the credit reports expire after 4 months. So we would be forced to re-pull after the 4 months if the client's still in the marketplace. So let's say, they had a baby, they're going to put it on hold. We don't just keep re-pulling their credit if they're not actively shopping. Let's say, I have several clients, they're like, hey, Pam, I'm back in the market. Now we would refresh their credit once they're out looking at homes. But after 4 months is when we would have to, if they're currently actively looking, or we would have to close before that expiration date.
So when you refresh, is that a hard pull or is that a soft pull?
It is a full inquiry. Yes.
Okay.
Yep. Now, a lot of people are concerned with credit inquiries, which is good. However, typically speaking, one credit inquiry should have little to no effect on someone's credit. And so I'll have a lot of folks, like when they're looking to be pre-approved, like, oh, I don't want to have my credit ran, which I understand. You should monitor those credit inquiries. However, I believe a loan officer looking at your credit is probably going to be able to give you really good pointed feedback on how to improve your credit scores. So typically I think of me looking at it as hopefully being a positive outcome at the end of it. And that one inquiry should have little to no effect. I kind of sometimes get frustrated with these credit repair companies because I don't see them actually truly helping clients' credit, where I can give them advice for free that that doesn't cost them anything. So these credit repair companies are charging a monthly fee, and I don't ever really see really big positive outcomes when it comes to improving scores, where I could have just told them what to do for free. I think when it comes to credit, it's like working out. There's no like secret pill, if you will. It's doing the right things typically. You know, using the credit card, like I mentioned, is really simple and something that we as consumers are really never told how to use credit. You know, I remember as soon as I got to college, I was offered a credit card. The first thing I did was I bought some books. I went to the mall, I maxed it out. I crushed my credit right away. So we're not taught how to use credit. I think it should be, you know, right in high school. It's like home ec and credit, financials, you know. But using it in the right way is actually really simple. So, but the creditors, they don't want us to, you know, succeed with credit. They want us to fail so they can charge us higher interest rates. So there's my rant.
Does anyone else have any other questions for Pamela while we have her online? Okay. Well, if there are no other questions, I want to thank everyone for coming out and joining us this morning. We truly appreciate you spending your Saturday morning with us. Pamela's contact information is up on the screen. So if you do have additional questions, please feel free to reach out to her directly. Stay looking at both Flo, Tonette and I's Facebook page, where we'll announce our next webinar. We want to thank you again, Pam, for giving us your Saturday morning as well. Thank you, everyone, for joining us, and have a wonderful day.
Thank you all. Thank you for having me.